Hi, and welcome to Biztech's Inside Trading Show. The show is all about trading. Every week, we discuss what trading is all about and all the required habits to help you make money and become a successful trader. We'll also share great trading ideas and themes, all of which we hope will help you make money. Now, with me today, as always, is my co host, Pang V. Leung. He's the founder and CIO of Track Record Academy. V, welcome to the show.
Hey Brian, it's good to be back. Let's talk about trading.
Now, V, as always, we start with um, a quote, and I'm going to share what you have just put up in the slides here.
So we're going to talk about something that's not from market participants, but from Mark Twain. He says history doesn't repeat itself, but it often rhymes, right? So what can learn from this is that first of all, it's not only trading wizards will have trading quotes. I think we can take life philosophy and adapt it to trading as well, because trading is a lot like life. And what this means is that although we do not see repeats of history in the future or in present that we live in, we can learn a lot from history and use it as parallels uh, to the scenarios that are possible in the paths that we see going forward for different macroeconomic situations as well. So I think in layman terms, we can learn how to trade better if we understand history of markets.
Now, V, so here's the interesting bit as well. You know, a lot of the world's great traders look at history to try to predict the future. And one of the biggest and most successful ones is Ray Dalio. Now, he doesn't only take recent history as a guide, he goes back hundreds of years. So there's really a parallel in terms of human behavior and how predictive it can be moving forward.
Yeah, you're exactly right about that, right? I think the reason why we have a history rhyming through the ages is because there's a common participant, right, which is the human being, right? And human beings, as an individual, it's hard to predict, but as a mob, as a masses, it's quite predictable over long periods of time. And
Okay, now V, help us understand in the today's context on in recent history, perhaps, where
okay,
this actually makes sense.
excellent. So on that note, we'll go back to revisits, not so far back into the past, but just 2020. I think we saw in 2020 we saw that no need to be reminded, but we all know this COVID crisis. What happened was that the economy suffered. The Federal Reserve, the central bank in the US, the most important central bank in the world, started cutting interest rates and ma- massively printed large amounts of money to buy bonds, keep interest rates low, right? Which they call it quantitative easing. So because back then there was no inflation pressure, there's no price rises. We live in a world of deflation, disinflation. So we were very comfortable with zero interest rates and massive printing, massively printing money in massive amounts to buy bonds to keep interest rates low, right? And they were worried about markets. They were not so worried about inflation. And most importantly, unemployment was really, really high. And we can see this in the data. In early January of 2020, inflation was below 2%, above 1%, and that's below their 2% target. So they're very comfortable. But then it dropped below 0.5% because of the COVID shutdowns. And then they started to worry. And unemployment jumped from 4+% to double digits above 14%. They panicked and they started to cut interest rate, cut aggressively, and the consequence was, as we have seen, economy started to reboot. The unemployment dropped, were created. So we have seen since then lots of jobs being created. However, the problem was inflation started to pick up, and that was a big problem because we were in a world where we haven't seen really inflation being a problem for some time. So that
Yes, and
started.
in fact, I think the last time we've seen sustained inflation is really during the Paul Volcker era in the 70s.
Yes, yeah. So 70s and 80s last inflation scare that the world actually remember, right? But we did have minor scares, but there's nothing close to this spiral of inflation upwards. So, but because in early 2021, still we have not yet seen anything like this for what 20, 30, 40 years. 40 years, yeah, 40 years. So most of the people who saw it, they're pretty old now, right? So that was not a worry. So because of that, as inflation started to trend higher, what the Fed said was that it's transitory, right? I think maybe now, after more than a year of interest rate hikes, we some people may have forgotten this, but in as late 2021, right, they were still telling us interest rates can stay low because inflation is transitory. What we are seeing in the rise in inflation is going to be temporary, and we shouldn't be worried. But then, by the end of 2021, in November, they started to say, actually, it's not transitory at all. It's a problem. We should start to hike interest rates, right? So what we saw is that in 2021, right, they said inflation was transitory when it was above 4%. And have mindful, remember this, their target was 2%, and we were at 4%. And they say it's temporary, it's transitory, we shouldn't be worried. And we went up to almost 6% before they said, actually, I'm so sorry, right? It's not transitory. Let's do something about it. And then, of course, they started to react in early 2022, which is just last year, March 2022. It was the first rate hike. And then the rest, most of us will remember, they continued to hike interest rates for 10 meetings in a row. So now we are here to the present. So what the present worry that we have is no more about joblessness, not so much about markets. It's all about inflation, right? So how is inflation doing? So the latest US PCE price index, which is the Fed's preferred measure of inflation, shows us that inflation is trending lower, right? It's either at the pace that was expected or even faster than the pace expected by most market participants, right? And it's the lowest headline print since April 2021. This
So,
was
V, one of the things is also suggesting then is, of course, because the inflation is often and rate hikes are often have lag impacts. So we are essentially seeing now the lags from last year's intervention by the Fed.
Yes. So this is exactly why the Fed said they would pause. That's why Fed paused the interest rate hikes in June. They said they wanted to see more of the lag impacts. It's not immediate, right? You don't hike interest rates today and then expect a slowdown in today. It needs to filter through the banking system, the economy, and then finally to the consumer. And then finally they change their spending habits, and then you finally see it in prices, you see it in demand, you see it in consumption, and then you start to see it in the various metrics that we are using to measure inflation, right? It takes time. So this lagged impacts, it's the estimates vary between 1 year to see one to 2 years before you actually see the full impact of an interest rate hikes. And most of the interest rate hikes started in the interest rate hike cycle started in March last year, and most of it happened towards the end of last year, right? It's the second half of last year. And what we have seen since then is that inflation peaked in the middle of last year. In the middle of last year, around July, it started to trend lower, and we're seeing this trend of disinflation, right? Basically, we are not seeing deflation, but we are seeing disinflation. Inflation is moderating from the highs, and it's been going down since the middle of last year. So we don't see it just in inflation data, we see it in different metrics that like the ISM manufacturing prices. It's released on Monday. It's lower than consensus, lower than previous. So it's all pointing to disinflation, right? Like prices are not going as high as before, not going up in a pace as high as fast as before, right? But what is the Fed saying to us? They say says a lot of things, but basically what they say, the risk of inflation is to the upside. We need for disinflation to come into play, the process will take some time, and it needed to be moving decisively towards a 2% target, right? Headline inflation has come down, but that's not a function of interest rate hikes. It's just energy and food prices coming off. But that's also disinflation, right? And more importantly, they keep reiterating this, that the process of getting to the 2% inflation target has a long way to go. So the last observation of the headline inflation from their preferred metric is 3.8, but their target is only 2%, right? So is it a long way? So you have to see, right? So what if you translate all these statements that he says into two real sentences, right? What he's saying is current disinflation is transitory.
And that's
And
an interesting observation. They've deliberately avoided the use of that V, but you've correctly pointed out that's exactly what they're saying.
yes, right. I think they used to say inflation was transitory. It was only 2 years ago. Yeah, 2 years ago. And they broke that observation quite 6 months later. They discarded it completely. And I think it would seem a bit foolish for them to say now again, if they use this term, they say if they start to say disinflation is transitory, I think the markets will wake up immediately to the fact that we've been down this path before. Is it really transitory though, right? And do we really want to see more persistent disinflation? What happens when the observations get to 2%? Does it mean it's going to stabilize there, or is it going to undershoot the target, right? More likely, as we have seen in the past, inflation do not stabilize that easily, right? If it's going higher, it tends to go higher until you do something to stop it, and then it starts to go lower. It tends to go lower until you do something to stop it. So the question is, are we
And the
past the
only
point?
thing, V, and I
Yes,
want to stop you there, the only historical case in recent times, in terms of a country where they've had this a completely opposite problem, is actually Japan, which has been in a disinflationary environment for decades, which it has only recently broken this year.
yes, that's actually correct, right? And in fact, Japan was the example of never to get into a deflationary spiral, right? Because once you get into it, it could become a problem that you can never get out for. And in fact, has not gotten out of it since, well, since the 80s actually, right?
Yeah,
But
so bubble economy in 1989 when the
yes,
bubble burst.
yeah, correct. So yeah, really, this could be a real problem if we start to go into deflation territory. So right now we're still in disinflation. So I think they're very comfortable telling us in various sentences that essentially translates to disinflation is transitory. So I think uh, the key point I want to make today is that they have made us this observation in the past, right? But that then 2 years ago they were saying inflation was transitory, and then it turned out that it really wasn't, right? And it came out of left field, came out of nowhere. They said it was, then it wasn't, and it started on a hiking spree. And then now they're telling us in different words, but disinflation is transitory, right? So what will likely be the outcome? I mean, it's up to you to guess, right? I think we all don't have a crystal ball into the future. But if you look at a chart, right, like I'm going to show you here, if you see this trend of this gray line is the trend of inflation. In early January, it started to go higher and higher and higher. And then they said inflation was transitory. Let's not worry, right? Target is 2%. We are above 4%, but we are very relaxed about it. We're going to let it pull average inflation up. That's what they said. And in November, they took this term of transitory out of their lexicon. It's not transitory anymore, and they started hiking interest rates in March. All these blue bars is represent an interest rate hike. So as you can see, they started with 25, then they did a 50 basis points, then they did four
75.
75 basis points, and this was the brunt of this aggressive rate hikes. They all came in second half of last year, from June onwards, right? And as you mentioned earlier, the lag effects, it takes around 1 to 2 years. And right now we are in July. We're going to see most of the lag effects starting to come through towards second half of the year. And as you can see, back to this gray line, from June last year, inflation has been coming off, and coming off quite aggressively too, right? In fact, the point
Mhm.
of inflation right now is below the point when they say inflation was transitory, right? and it's proving to be transitory now, I think. But what they're saying in all the words they're saying, so now they've hiked interest rates by a lot. It's come to very high levels, above 5% now, and they're insisting inflation is too high. Upside risk remain to the ups, remain in inflation. It's not downside risk. Uh, Essentially, all translate to this, which is the key point we are trying to make here today, is that they are telling us this inflation is transitory. So the
and
question is, are they going to be right this time, right?
and also then how do we react if we think they are wrong?
I think uh, alluding to our previous episode, ours, we our last episode, in fact, we pointed out that there's bull markets happening that is happening below the radar of most observers. For example, cryptos, the price action is really bad, really good, despite the really bad news that we are seeing in the headlines in media, right? And stocks markets are recovering. So markets tend to price ahead, right? People are predicting recession, people are predicting, but markets are starting to do well. So it's possible, which we are seeing too in interest rate futures markets, that the markets are expecting interest rate cuts next year, right? They tend to have a prediction of what, because their forecast of the economy is very different from the Fed's. The Fed thinks interest rates are going to stay high, in fact, could go higher, and could stay higher for a much longer period of time, because they still think that inflation is a problem, right? And essentially, it all boils down to the same thing again. They're telling us this inflation is transitory. So, but what if it is not, right? Then the next problem that they have to address is actually the undershoot of inflation below the 2% target, right? And I think this is a precursor to some of our episodes ahead, where we're going to explore how are we going to be prepared for the event, right? Where I think most people now are very accustomed to the inflationary environment. I mean, we don't like it, but it's talked about in the press. Everybody talks about it. The Fed talks about it, right? All your friends talks about it, right? All your friends talk about it. So
Yes.
markets are conditioned to the environment. But what if we transition to an environment where the Fed has done too much and continues to go into a zone of policy error, and they're keeping interest rates too high for too long? And what are the market opportunities then, right? I think uh, that is the crucial point we're trying to make today, that if it should turn out that this inflation is not transitory, we could be looking at many good risk reward opportunities in the markets ahead. And
And
on
we
that note, I would like to also add, sorry to interrupt you a little bit.
No
I think most
problem.
people were questioning, is it possible that policymakers are wrong, like they know so much more than us? But let's just bring back closer to home an example that's not so far in the past, where Australian central bank governor said in 2021, said that interest rates will stay low until at least 2024. And then that's next year, right? But although they said this, they started hiking interest rate in 2022, and then they continued to hike interest rates up till last meeting, right? In 2023. And what they did after in November, when the journalist asked, "What about your promise to keep interest rates low till 2024?" He actual quote is, "I'm sorry if people listen to what we have said." Right. So right, right now, the question is, should we be listening to the Fed, or should we be listening to the markets? Right. So I guess that's what we have for you today.
Now, V, it's been a fascinating conversation and really a different insight compared to what media across the world are talking about. Really, thank you very much for coming on the show and thanks for your insights.
It's always good to be here talking to you. Let's do it again soon. Cheers.
We've been speaking to Leung. He's the founder and CIO of Track Record Academy on Biztech's Inside Trading Show. I'm Brian Fernandez. This interview will be on our website, www.biztech.asia, as well as our syndication partners, TV stations, radio stations, and websites. Thanks a lot for tuning in.